Hello, it's Friday, the 22nd of May. Fairly positive out there this morning, and indeed, you may not realise this, but if the US continues in its sort of positive vein this week, we're actually going to have 8 consecutive positive weeks out of the US. It's the first time it's done that since 2023, despite all the news flow and everything else. I suppose some context, as ever, is important to these things, and the US was a bit of a laggard actually at the start of the year. It was sort of bumbling around a little bit. We then, of course, had the US and Israeli attack on Iran at the tail end of February. All markets sold off, including the US. But since then, the US has actually done pretty well. And I suppose in the US in particular, we've actually seen a return to the theme that we've seen over the last few years. So sort of growth-orientated, technology at the forefront, and actually the largest companies doing well in particular. Let me give you some context for that. Over the last 3 months, which is a reasonable proxy for the period since that attack on Iran, it's a couple of weeks off it, of course. Over 3 months, you've had the US, the S&P, so the main board of the US, the market capitalization weighted exposure to the US is up around about 8% in sterling terms. Over the same period, the equally weighted index, a less market cap bias because it gives every single stock in that 500 an equal weight, that's essentially flat over the same period. So a significant impact obviously coming from the larger names in the index. If we concentrate that further, the Mag 7, the sort of tech bellwethers, generally sort of massive businesses and all the rest of it, whereas the broader index is up 8, they're actually up 12. So you can see again, certainly in this most recent period, the sort of Magnificent 7, the tech orientated, the large cap, the growth, or the mega cap, and the growth really sort of returning back to the fore. There's been some interesting regional differences over that period as well. The US up around about 8. Emerging markets doing similarly in sterling terms over the same period, whereas UK and Europe are very firmly laggards over the same period, despite starting the year actually on the front foot and outperforming the US up until the attack on Iran. As of now, UK and indeed Europe in sterling terms are both down between 1 and 2% over the last 3 months, whereas the US is up that 8%. So a decent gap over this period. It's diminished over the course of the entire year because the US lagged at the start. But, you know, again, some interesting regional differences. Emerging markets performing similarly to the US. I think, again, that sort of broader tech story benefiting emerging markets. And indeed, markets like Korea, for example, outperforming further still due to their sort of concentration and indeed sort of leading into that tech story there. So lots of regional differences going on, but generally still, if you take a step back, it's a positive start to the year despite the geopolitical challenges that we've seen since the end of February. We have to talk a little bit about Nvidia. Had their results this week. They were blockbuster results. I'm sure you've seen them. There's so much sort of good news out there in terms of the scale of those sales, the ability to turn it into revenue, and indeed the forward guidance was very good as well. The response to that, though, was actually a bit indifferent. In fact, the stock was off, 1 or 2% on Thursday this week. That is not a big deal. Obviously, it's done really well in this last couple of months. But it's quite interesting as the success grows around this stock and indeed these cohort of mega cap names, the expectation ratchets up as well. Oddly enough, in these results, the expectation was almost to exceed expectations. It gets harder and harder for firms that are that successful to continue to impress investors. But my goodness, an impressive set of results, that's for sure. Less impressive, perhaps, we need to spend a moment looking at the UK. If there is a change in leadership in the UK, which is looking fairly likely to happen, whoever leads the UK at the end of this year has their work cut out for them. There's lots of data coming out this week. A mixed picture, I think it's fair to say. We've got the 10-year in the UK, around about 5%, give or take. And so not only have you got a sort of growing debt burden, you've got a high level of interest to pay on it, which is a difficult environment in which to operate. At the same time, consumer confidence we saw this morning under pressure, particularly amongst lower income households. Consumer spending also coming under pressure. Despite that sort of easing of inflation, which is largely driven from services at the start of the week, there's still lots of concerns in terms of sort of economic activity, which is understandable. What's the sort of easy way to sort of envisage a way that this sort of gets fixed? Well, there's a very sort of detailed fiscal answer to that, of course, but more sort of practically speaking, one of the sort of simplest ways to get things moving a bit in the UK would be to see oil price come down. That, of course, relies on essentially the Strait of Hormuz opening, and there doesn't seem to be any material progress there. There seems to be a desire from the part of sort of both sides to get something agreed at some point. But the stalemate is now quite protracted. And in fact, the ceasefire is longer than the kinetic part of that conflict. So when we think about the gilt market in particular, there are challenges. Yields are higher. This week, though, they haven't moved particularly. And in fact, this recent sort of borrowing news was greeted with yields coming down slightly. So despite the fact it surprised on the negative, the gilt market wasn't particularly moved by it. But, that's why when we look around government bonds generally, we think there will be a level at which the UK gilt becomes attractive again. We're neutral on it today. We think, it's got a lot of sort of potential idiosyncratic risk really sort of in that asset today. It's still, a high quality credit, but, not perhaps one we want to have a large allocation, and certainly not sort of overweight to. Whereas other global government bonds, diversified global exposure, we want to use that as a portfolio sort of diversifier. So we have that as a 4 out of 5 in our tactical views, whereas the gilt market, we have a neutral 3 score of that. So we're leaning away from the gilt market modestly into a more sort of diversified global exposure to reduce that idiosyncratic risk to the UK curve. That's it from me. Have a great weekend when you get there, and we'll see you next time.